Hi everyone, Nathan Taddeo from Credo here. I'm here with Fiona Clark from Fiona D. Clark & Co. Now Fiona's a lawyer and I want to have a bit of a chat with Fiona today because one of the big things we're getting a lot of questions about or have a lot of people inquiring about is a family guarantee option or a limited guarantee option for their loan. Now, it's a pretty prominent structure these days. The whole idea of a family guarantee, Fiona, as you know, is a client may have the ability to service the loan they might need to buy that particular property.
Correct,
but they won't have, they might be lucky to have 10%, maybe 5%, but they have the ability to borrow what would be needed to get there. They just want to avoid the mortgage insurance. So one way we'll do that is say, okay, well, you still put your money in, most of the time, but also it's to get to the overall security below 80%, the parents, it's typically the parents, can let the lender lean against their property so that the lender's overall security is below 80%.
Correct,
Okay, now I don't want to get too much into the overall structure. Obviously, I can talk to people about their specific numbers and what that would have to mean. But I do want to talk about how we like to structure the loan, and then also because there is a lien on the parent's property, they provide a guarantee, which is a security guarantee, not a servicing guarantee.
Correct,
You get me to answer a few common questions or some common misconceptions about what that might mean for what is typically the parents on their property. So typically when we'll do this, we'll like to split the loans into two. So we have the bulk that is the client's home loan.
The debt of the property.
That's right, the debt of the property they're buying. And then the other bit we'll like to split off to, we say, represents the debt that is leaning against your parents' property. So we can focus on paying that one off quicker. Now, obviously, both would typically be principal and interest loans, so they're paying off at the same rate, but any extra money you might want to put into that one. Or you might fix the home loan and then really focus on having the variable small portion against your parents' property. Now, obviously, to clear the parents' property, because what the bank needs is below 80%, the loan is below 80% of the security value. Your property, in theory, should be going up in value, the loan should be going down. So it's not just pay that off, but at least make that nice and visual that we know we want to get this bit as close to zero, so we can release money from that property.
As soon as possible, correct,
Now, obviously the questions we get asked by clients, they say, look, mum and dad might be on board, but what does that mean for their property? Like, what are they putting up? What are they risking? So can you sort of give us a bit of an idea?
So Nathan, interesting question. I guess what the parents need reassurance about is they might, be in their 60s, they've paid off their home loan maybe to a zero balance, and they have what we call an unencumbered title. The kids come along and they buy a property, and then the finance broker suggests to them, look, is there a possibility of your parents adding their property as security? And that rings alarm bells for parents thinking, well, what's the jeopardy for us?
We've just paid off our house.
Correct, we've got an unencumbered title. So the scenario is the bank take the parent's property as security, there is a mortgage registered on the parent's title, but it's for a limited amount.
That's right. So as an example, let's say the client needed to borrow $450,000 against a $500,000 property. $400,000, that would be 80% of the property's value, so there's $50,000 of limited guarantee sitting against their parents' house.
Correct,
So let's talk worst case as an example. What does that mean?
So I guess initially the parents have to have independent legal advice before signing any documents. The independent legal advice is to explain to the parents that the risks involved. The risks being that the kids are responsible, they're the borrowers, they're responsible for paying the monies back to the bank. If there is a default under any circumstances, the kids can either refinance, sell that property and pay back the debt. The risk to the parents is if it stays in default, then their title that's being used as security, that property, worst case scenario, could be sold, the money that was secured against it repaid, and then the parents get their title back.
Is that so? A lot of time, let's talk worst case then. So in that $500,000 example, let's say the kids went bankrupt, or something really bad happened day two or 2 days after they settled, the bank would come to sell the kids' property. In this example, they have $450,000 of debt against a $500,000 property. If the bank only got enough to say settle $430,000 of that debt, the options would be either there's $20,000 debt here, can we get something else to secure it? Can the kids still service that, maybe as a personal loan instead, or whatever it might be? If the kids aren't around, who's going to take on that responsibility? Otherwise, worst case, that's against the parent's house. Can they now come in and take that off?
The parents can only, whatever's been guaranteed, the amount guaranteed by the parents plus any interest and costs like that, that's all the bank can recover. They can't take more than that.
Gotcha.
So if there is a loss, the bank have to wear that loss, or they can go after the children for that loss.
Yeah.
They cannot come after the parents for that difference.
There you go. And they cannot sell the parents' property, or they can enforce, unless worst some case someone has to pay this out. That might have to mean there because you have secured it, but let's look into other options.
Absolute worst case scenario, they could sell the parents' property to get the 50 grand, but usually there's money or some other way that the parents would say, look, here's the 50, give us back our
Sure. So I guess that's the big thing. Absolute worst case, there is always some risk because you are living as the house, but we have to have that discussion about, okay, are we happy what that number looks like, and what are the mitigating circumstances? What can we talk about? A solution, knowing that if it did happen, what would we do about this amount? And that's also why we like to keep it roughly in that personal loan or an achievable number, rather than going $300,000.
And part of the workup is doing the numbers beforehand, getting the parents in, explaining everything to them, explaining it to the borrowers, because at the end of the day, the buck stops with the borrowers.
Absolutely, and that's one of the positives about the family pledge is you're not going and asking parents, hey, can we have some money to help us buy the place, because that's something a lot of them don't want to do for a variety of reasons. You want the loan to be your responsibility. It's your time to buy your house.
Yeah.
This gives you the ability to lean against your parents' fortunate situation, but not go and ask them for something like money. Just say, hey, can we lean against you? But everything's our responsibility. The loan is our responsibility. The payments are our responsibility.
And the other instance is if the parents may not necessarily have an unencumbered title, they may also have borrowings.
Yeah.
So this would be a second mortgage that would go to by their mortgage.
Yeah. So that's great you touched on that. So one of the things we do try to do is, if that is the case, typically we'll go with that same bank because that bank already holds it. Sometimes they might not want to release have a second mortgage over it anyway. Yeah. But also, well, if there's some loan there, they're already working off that. Should absolute worst case, they understand the risks. The other thing we'd like to preferably do is, if it's an option, is not go against the parent's home, we can go against an investment property or a holiday house or something like that.
Of course, that's the option.
Absolutely.
It doesn't have to be the principal place of residence.
That's right. And it's typically preferred because, again, absolute worst case, the parent's house is protected.
Correct.
Yeah. So I think that explains most of it. Do you find there's anything common questions that come in? So when you do all this, obviously at the end there's the mortgage documents that we'll sign, but also the parents will get their independent legal advice for the guarantee document from the bank. Is there anything that comes up often from the parents other than, hey, am I okay here?
I think it is a reassurance thing, Nathan, there's no doubt. I think the structure that's set up, that there's the two loans, so that the borrowers can pay back the initial loan that's debited against any parental pledge, is probably a good structure.
Absolutely, yeah.
I guess explaining to the borrowers that, it is an obligation to the bank, it's a financial obligation. Before you buy your movie tickets, you pay back your loan.
I like that.
It's about living, but you've taken on an obligation, and the parents have been very generous in providing this pledge. It's, should be paid back first.
And we do find that, as they start to focus on paying that down, we might get the property revalued after 12 months, might be there or right on there or thereabouts. But when they are able to actually go and release the parents just with a discharge form, release that property, it's the best handshake you can say. Thanks, Mum and Dad.
Correct.
You helped us get here. We avoided mortgage insurance, which could have meant a huge savings in interest over the term of our loan. But hey, we don't need that anymore. Thanks very much. Here's your title back.
And I think you also summed up, it's imperative when you do your financial analysis at the start, to make sure the kids have that payback facility.
Absolutely, yeah.
And, do worst case scenarios.
Perfect. Okay.
Yeah.
Well, I think that's a pretty good intro to what a family pledge might mean, without giving too much in the actual advice, it's sort of a general idea of it. Obviously, we will require legal advice, so a lawyer like yourself comes into play there. But if there are any questions, as always, obviously you can call us if the structure might fit you or want to run some numbers. And Fiona, obviously, we can always pass on your details.
Absolutely. Delighted.
Independent legal advice.
Yeah.
Thanks very much.
Thanks, Nathan.